In 2003, a new version of cricket, T20, was introduced by England. 5 years later, India, initially reluctant, embraced the format as the BCCI launched the Indian Premier League, or IPL. Now, the T20 tournament has grown massively to be ranked among the world's top 5 richest sporting leagues in terms of business. The recent sales of Royal Challengers Bengaluru and Rajasthan Royals have further boosted the IPL on the global stage and also delivered stronger returns for investors in the game. In 2008, the IPL had just begun with 8 teams. At that time, Royal Challengers Bengaluru was bought for around $111 million. The league itself was new, experimental, and in many ways uncertain. There were questions about whether a franchise-based T20 tournament could sustain interest over time. Fast forward to 2026, and that same franchisee has been sold for $1.78 billion. That is nearly a 15-fold increase in value. In percentage terms, it is a jump of well over 1400%. A similar story can be seen with Rajasthan Royals. When the team was first bought in 2008, it was the cheapest franchisee in the league. Today, it has been sold at over $1.6 billion, making it one of the most expensive teams. These numbers are not just large, they are unusual when compared to traditional investments. Over the same period, Indian equity markets have done better, with long-term returns in the range of 12 to 15%. But the growth seen in IPL franchisee valuations translates to annualized returns that are significantly higher. One of the most striking examples of this wealth creation comes from the late Australian legend Shane Warne, when he was associated with Rajasthan Royals and led the team to the IPL title in the inaugural edition in 2008. He chose to take small equity stake in the franchisee rather than relying only on his playing contract. At the time, the IPL was still unproven, and such a decision did not attract much attention. Today, that roughly 3% stake is estimated to be worth around 450 crore rupees, which Warne had left for his dear ones with his astute investment. What this illustrates is a fundamental shift. Cricket is no longer just generating income through salaries and endorsements. It is creating wealth through ownership. The question then is, what exactly is driving these valuations? The most important factor is the IPL's media rights model. In 2022, the broadcasting and digital rights for the league were sold for over $6 billion for a 5-year period. This translates to more than $1.2 billion annually flowing into the ecosystem. A significant portion of this revenue is shared with the franchisees, giving them a predictable and substantial income base every season. This central revenue sharing structure is critical. It ensures that teams are not entirely dependent on local factors like ticket sales or match day performance. Instead, they benefit from the overall growth of the league. Beyond media rights, sponsorship form the second major pillar of revenue. At the league level, the title sponsorship deal with Tata Group is estimated to be around 500 crore rupees per year. In addition, there are multiple official partners and sponsors contributing several hundred crores more annually. At the team level, sponsorship revenues are even more layered. A franchisee like Royal Challengers Bengaluru typically secures a primary jersey sponsor, which alone can be worth between 70 to 100 crore rupees per year. Secondary sponsors including sleeve and back of jersey placements add another 40 to 80 crore rupees. On top of this are associate sponsors and brand partnerships. Taken together, total sponsorship revenue for top teams can exceed 150 to 200 crore rupees annually. Match day revenues form another component altogether, although they are smaller compared to media and sponsorship income. These include ticket sales, corporate hospitality boxes, and in-stadium advertising. While not the primary driver, they still contribute meaningfully, especially for high-demand franchisees. Merchandising is another area that is growing, though it remains underdeveloped compared to global sports leagues. Official jerseys, fan merchandise, and licensed products are increasingly being pushed as teams try to build year-round engagement. What emerges from all of this is that an IPL franchisee today operates as a diversified business with multiple revenue streams. Importantly, a large part of its income is tied to central media rights, which have shown a consistent upward trajectory, with each new cycle. This is what that sets IPL franchisees apart from traditional investments. They benefit from a structured revenue sharing model, rising media consumption, and strong sponsorship demand. Another factor driving valuations is the entry of global capital. The recent sale of Royal Challengers Bengaluru involved a consortium that included major global investors as well as large Indian business groups. Similarly, the acquisition of Rajasthan Royals involved international investors. This indicates that IPL franchises are now being viewed alongside global sports assets, such as football clubs in Europe or basketball teams in the United States. Investors are not just looking at current revenues. They are betting on long-term growth driven by India's expanding digital audience and advertising market. However, there are important limitations to keep in mind. Unlike stocks, IPL franchises are not accessible to the average investor. The cost of entry runs into hundreds of millions of dollars, effectively restricting participation to large corporations and private equity funds. Liquidity is another issue. These assets cannot be bought or sold easily. Transactions are infrequent and depend on finding suitable buyers, which makes the exit more complex. There is also the question of valuation versus profitability. In some cases, franchisee valuations are rising faster than their underlying profits, suggesting that investors are factoring in future growth rather than current earnings. Even with these caveats, the broader trend is clear. The IPL has evolved into a high-value asset class that sits at the intersection of sport, media, and entertainment. Cricket in India, turns out, is no longer just a game. It is now a billion-dollar business, and at least for now, it is outperforming traditional investment.